Brent oil rose above $91 per barrel as a storm threat shut a quarter of US offshore crude and gas output. Oil is on track to post its biggest quarterly fall, though, since the financial crisis in 2008, as the Eurozone crisis and weak growth in the US roiled global markets. Joining us for some more insight is Richard Swann, who is Global Director of Oil News at Platts. Richard, we watched the oil price go down quite rapidly from in the mid-20s to around 100 and then down to 96, sat there between 96 and 102 for a while, then dropped quite sharply to 90, where it's been for a few days. What's your reading of what it's going to do?
Well, I think fundamentally what you're seeing here, David, is the reassertion of the fundamentals. If you wind the clock back to last year, there were fears that you had a tight oil market and lots of potential problems relating to Iran and what might happen with that country's oil exports and fears about loss of oil shipping from the Middle East. That's all taken more of a back seat. Now what we're looking at is the weak demand picture you've painted for us. We have huge problems here in Europe. But also Chinese demand is not fizzing the way it was in recent years. And also on the supply side, there's a lot of oil out there on the market. Those two factors are combining, and we've had this pretty rapid fall. I mean, prices are now, as you say, around $90 for Brent futures here in Europe. That's the lowest level they've been at for about a year and a half. So we've given up a lot of gains very quickly. And even today's news, you referred to the Gulf of Mexico problems from the tropical storm. There's also a strike offshore Norway shutting in quite a lot of production in the North Sea. These two combined mean that traders came into work this morning and they're looking at a combined supply loss of 500,000 barrels a day. There was a little fillip earlier in the market, but it's pretty much gone away. The market has taken a 500,000 barrel a day outage in its stride because that's not enough to change the fundamental picture here.
There was an OPEC meeting, I think about 10 days ago, where it was decided not to change the quotas that were planned. The significance of that?
There's a lot going on there, yeah. It looked at first glance that the OPEC meeting in Vienna on 2 weeks ago was pretty much rubber stamped the status quo, but there are problems. That meeting took place at a time when the headline price was around $100, and already some of the cartel's members were complaining that they wanted the price, that they were worried by the recent slide, and actually OPEC should rein in what they saw as excess production. They weren't able to do that. They've left their formal ceiling unchanged, but they're producing well above that. They have a formal ceiling, let's not forget, of 30 million barrels a day for the group as a whole. Platts' estimate of OPEC production in May was 31.75 million barrels a day, so substantially above that. The biggest sort of proponent of the increase is Saudi Arabia, which is pumping at near historic highs at around 10 million barrels a day. And Saudi Arabia, crucially, gave no indication at the OPEC meeting that they were worried by $100 oil or even coming on down. Since then, we've lost another $10. We're at $90 now. And now we're starting to wonder, where is the pain point for producers here? How much longer will producers be happy to watch the price fall before they start cutting production, essentially?
Well, we've talked a great deal in South Africa in the last couple of weeks about the platinum sector and how several platinum mines have been put on mothballs or closed temporarily because there's too much supply. So you manipulate the market. Well, in another sense, it's the market working, isn't it?
It is. In the oil market, sort of forced shut-ins like that for economic reasons are rarer, mainly because the capital investment in a lot of what we call the upstream production projects is huge. The producers want to do everything they can to avoid a scenario of barrels being shut in. But if you think we're talking $90 for Brent, well, don't forget the US benchmark WTI is below 80. It's about $79 as we speak now. And a lot of crude oils in North America, particularly in Canada, trade at a discount to that. So there you might be talking the 60s and 70s. That's a much lower oil price than we've seen in the last 18 months. And in some of the very complicated projects, you are getting much closer to the marginal cost of production. So we're not there yet. But again, you come back to this point, if the oil price keeps falling, you'll have producers at projects like that, expensive projects, who will start feeling, is this worth our while to keep pumping? On the political side, big oil producing countries, particularly some of the ones in OPEC, they need a high oil price, not to cover their costs, but to finance their budgets. So that they face a different set of issues, but with the same result. They're not happy with the oil price fall.
If we look back several years, the kind of range that one thinks about is not 90 to 100 or 100, 120. I think it went as low as 50, and it was at $150 about 5 years ago, I think 6 years ago, and there was talk of it going to 200. So the imagination, if you like, around oil needs to be quite broad.
It's a very volatile commodity, let's not forget. Yeah, the peak oil price you mentioned was back a few years, but last year, although we didn't get up to that $147 record, last year was a record for the average. For the year as a whole, we have sustained high oil prices, and even now we've come down to 90. We're halfway through 2012, and again, the average oil price is very high in historical terms. So the economy is having to cope with the high oil price at a time when demand is very weak. But what's happened, though, is a lot of the new production that's coming into the market from places like Canada, a lot of the deep water projects around the world, they're high cost. 10 years ago, in a $40, $50 oil price environment, they wouldn't have got off the board. But you need a higher oil price, essentially, to make these projects work.
You talked about Europe and demand there. Now, whether Greece leaves the Eurozone or not, and we talked earlier about the views on that, you get extreme views. Yes, they will, yes, they won't. But either way, Europe's going to be in trouble. So even if a kind of solution is sorted out for Europe, the funding for the Spanish banks and so on, no one leaves the Eurozone, that's not going to mean a huge increase in manufacturing activity and huge demand for oil, or is it?
Well, Europe is already a declining sort of demand centre for oil, but the problem is it's still, although it's in decline, it's not where it doesn't attract the attention of China, but it is nonetheless a considerable consumer. If you add up the combined sort of consumption of the European Union, it's one of the world's centre points of oil consumption. So though it's declining, the rate at which it declines, interestingly, is what will set the tone there. But don't forget the knock-on impact of all the Greece thing. It's not just the direct impact on oil consumption in these countries, it's the knock-on impact from all the other financial markets, as oil and other commodities have become increasingly interlinked with these other markets as well. So it sort of hits you twice.
What about China? They had a rate cut, and people interpreted that as good news in the sense that they wanted to stimulate, but bad news that they had to. How much do those kinds of indicators from a massive economy like China's impact on the oil price and the likely future oil price? China's crucial to anyone watching the oil market. It's been the fastest growing oil consumer for years now. It's already the world's number 2, both in consumption and in imports, behind the United States only, and had been growing for a few years. It was growing at double-digit pace, which is incredible. So essentially, it's the marginal demand. So where's the oil going to go? Everyone's saying China, China. Look at the demand statistics now, not so good. The growth is much, much lower. There's still some growth. But it's nothing like the rates we were seeing in 2008 and 2009. So there's a marked slowdown there. So I think there'll be a lot of attention on China here. What is the appetite for more oil? What are they going to do? Because to an extent, if Chinese imports are booming, that sets the tone and everyone else has to follow. If Chinese imports tail off, then you're left facing what is essentially oversupply in the market. It's not just OPEC producing above its nominal ceiling. If you look at the estimates of how much oil is needed from OPEC to balance the market, it's way ahead of that too. So that current production level from OPEC of just shy of 32 million barrels a day, that compares with what should they have been pumping in Q2 to balance the market was only about 29.5 million barrels a day. That's from the International Energy Agency statistics. So you've got considerable oversupply. I'm not sure whether you're a fan of technical analysis. We've had a couple of technical analysts here saying that $96 an ounce is a threshold technically, and once it goes below 96, could go quite far. Which is another way of also asking you, how far could this go in the next, say, month or two?
Well, I think that was interesting coming out of the OPEC meeting. The absence of any strong signals from OPEC that they would defend a price floor, essentially. What's your pain threshold? There was no unity on that whatsoever. And some very good analysts sort of interpreted that as saying, the market's going to test the downside here. And lo and behold, that's happened already, just in the 10 days since the meeting. So we've come down another $10. And I think that's the big question. At what point will producers feel the pain? Right now, we're not getting too strong signals from many of them. But if you went down another $10 or even $20, then you certainly would.